multiple mitigations here. And this is where smart money traders would have got caught out. It's just a smart money trap. And price just used news as an excuse, used CPI as an excuse to take everyone out before it flew. That's all price did. It used CPI as an excuse. That's all price did. It waited to take out all of the early buyers. Everyone that bought early, everyone that bought in here, took them out, and then was like, thank you very much. All liquidity's been taken. Now we're gonna go. And this is where now we wanna buy. What I wanna go into, first of all, is the 1 hour time frame. And what I wanna go into actually is this price action in here on that day. And also I'm gonna show you this and how you could have preempted it, how you could have preempted that price was gonna wipe all of this out before it decided to go higher. And just so you can protect yourself going forward and you don't get into buys too early and things like that. But as you can see here, I've marked out already the multiple lows that we've got. So you've got price that's built up all this liquidity down at the bottom and at the top. So on both sides, before this day comes, you've got liquidity at the bottom and liquidity at the top. But the question is, what is price gonna do? And the fact is, if you look at this now, price is fully bullish, right? It's so bullish. This is just a build up. So if we're looking at this, what do I always say? Price has to first induce lower before it goes higher. So what you're gonna see is when you see moves like this, that's often, a sign that price probably is gonna reverse in the other direction if price is bullish. In this case, price was bullish. So you're waiting for that aggressive move down to then think, okay, we might get a reversal now. But what price is actually doing here, as I said, is building up. You got this low held, I believe. Yeah, create equal lows. So you got one low here, 2 lows, 3 lows, 4, 5, 6. So you got multiple lows that are created, and then so you've got this is the cycle. You've got build up, which is all of this. Sorry, it was not brush. So you got build up, which is all of this. Inducement, all right, and then you've got this the inducement of the initial push down, and the initial low, and you've got the mitigation of it straight after, which we'll go into in just a second. But what you will see by the time we get to the end of this breakdown is that there's cycles within cycles. So you've got a cycle on the 1 hour, you've got a cycle on the 5 minute, you've got a cycle on the 15 minute, and it's how you work out, how to trade cycles within the cycles. That's what will bring you the real success. And that's how you're able to hold trades longer if you know the bigger picture cycle, if you're able to enter on, say, the M5 cycle, so to speak. So what we can see here is price is built up, it's induced lower, okay, taking out these multiple lows, taking plenty of liquidity, and then for 2 days, price, or 2.5 or 1.5 days, price built up liquidity again, took out all of the early buyers. Because think about it, if you're someone that you managed to get a sniper entry in here, but then you tried to buy in here, it takes you out. And then you bought in here, or you bought in there, or you bought in there, or you bought in there, or you bought in there. What happens at CPI on Thursday? Boom. This wick takes everybody out. Boom. Sorry, that was a bit bent. Boom. Wick takes out everybody. There's no buyers left. All of the buyers have been taken out now. And that's when price wants to move. So where we want to get into trades is after all the buyers have been taken out, that's when you want to buy. And after all the sellers have been taken out, that's when you want to sell. If you look up here, I promise I'll get into the actual price action on the lower time frame in a second. I'm trying to just teach the concepts behind this. So you can see up here where so many things happen. Look. Up here you've got these highs taken out. Here, sellers have been taken out. So price then sells off, right? Someone tries to get nice little move in here. So you've got sweep, break of structure, mitigation, smart money, yeah? Smart money enters. So this becomes a smart money trap straight away. Comes down, this just becomes liquidity, these two. That becomes liquidity, and then look. So all of the early sellers that have sold get wiped out. If you sold here, if you sold here, both of you wiped out, then price sells off. And then this high holds, and this high holds. And then the same thing happens again. You got all of these sellers here. You've got multiple highs here, high here, high here, high here. Even the high here, it comes down, wipes out everybody down the bottom, comes back up one more time, even takes out this seller up here, and then we sell off. And then this high up here holds. Again, multiple sellers up here. There we go. If you sold early, you've got a sweep of liquidity, break of structure on low time frame, mitigation, comes down. Nope, too early, takes out the sellers, then price sells off. And as you can see from here, it does the same thing again. Breaks, sweeps liquidity, breaks structure, some kind of mitigation up here, consecutive mitigations, 1 high, 2 high, 3 high, 4 highs, all wiped out, then price sells off. You see it? It happens over and over again. Price likes to create a build-up, so it induces people to get in, takes them out, and then goes in that direction, right? So where we want to buy is after all the early buys have been taken out. Where we want to sell is after all the early sellers have been taken out. Are you seeing the patterns, right? Hopefully that's making sense to you. So let's get into the nitty-gritty of this now. So price on the 1 hour has built up liquidity up here. Built up liquidity in the top, the high side and the low side. It then induces lower, right? Then induces lower. And then, okay, so it's like, cool. All this liquidity has been taken out. So there's no reason for price to go lower right now after taking out all that liquidity. Price is bullish on the high time frame. Most of the buyers have been taken out. Now let's go down to the 15-minute. So you can see here, again, price has come down. And what's happening here? What's happening here? So you got this low here, make that thicker. And you've got these buyers. You've got a mitigation here of this low. You've got a buyer here. You've got a seller, so you've got buyers here, buyers here, buyers here. Look at these consecutive mitigations, right? All these different buyers. I'm aware of this would have been taken out when this came down here. I get that. And this might have been taken out when it came down here. But look, all these consecutive buyers here. 1, 2, 3, 4, 5. Listen, price is going to wipe that out. And that's exactly what it does at CPI. Wipes it out. And then price goes. And makes it move. Are you seeing the patterns? So when you're seeing these consecutive mitigations, that's when you should be worried. When you're seeing these, the trend line liquidity being formed, that's when you should be thinking, maybe I'm the liquidity here if I'm in this. But let's now break down the price action in here, the trades that could have been taken in here. Now we understand the bigger picture. So if I go on to the 5-minute. So what we know at this point is that we're expecting price to move higher soon enough because price has induced lower, taking out a lot of liquidity, right? And now we've got plenty of liquidity on the buy side. So up here, those people that are selling, they've sold off, and there's liquidity above all of these highs. So we know there's plenty of reasons for price to go there. The liquidity is the reason why price will go there. If there's no reason for price to go in a certain direction, you don't want to trade in that direction. What's the reason that price decided to take out all of these lows during CPI? What's the reason? The liquidity. Everybody's stop losses that are here. There's a reason why price took it out first and then went, right? News isn't random. Just best believe that. It's not random at all. Okay, so we're now expecting on Wednesday a reversal to happen at some point. What often happens, what I can tell you is when price comes down and does induce a low, especially when it's a major one or multiple lows, if you see price taking ages to reverse and building up liquidity, price is probably going to induce the low one more time. All right. And why I'm explaining this because this is why you have to think about your targets as well when you're trading in a certain direction. All right. But let's get into this 5-minute time frame because this is some juicy stuff. And now we're going to talk about build-ups and inducements. Okay. So we know that price could be reversed on the high time frame because it's induced lower, on the 1 hour. You've had this aggressive move down. But if we go on an intraday basis, and this is why on an intraday basis, you don't always need to look at the high time frame to get in and out of trades, because you're in and out on the same day. However, it is good to know what happened on the high time frame, because the high time frame is king. And sometimes you can be do the right things, but you're doing it at the wrong times because you're trading against the high time frame. So you got to know when to get in and out, right? So let's see here. So you got on the previous day, on the Tuesday, you've got the inducement low that's come down. Then price is starting to move higher. Then you've got these build ups. So let's start marking these out. So you got this channel build up there. So channels, really important. Really, they make things a lot easier to see in regards to liquidity. Channels, trend lines, especially. All right. So you got these channel build up here. You got an inducement higher, right? Also, these sort of times we're not trying to take trades. We only want to be taking trades really. So for me, I like to take trades during, say, Frankfurt, if I'm up for it. Frankfurt, London, New York, and London close as well. Right, so London close in UK time between 3 and 5 p.m. Right, so you've got a build up here, and then as you go into Asia, we've got another build up, and then this is you've got equal highs that are taken. Price mitigates it. Right, so immediately this then has become mitigated, so that this then area is, for me, invalid to take a trade. And then you've got build up here. You've got another bearish channel build up. So as you keep marking these out, these channels will become clearer and clearer to you. All right. So you got channel build up here, channel build up here, and then what you got here is at 6 a.m. This is UK time. Price moves higher. Right, aggressively induces the channel to the high side, takes out Asia high. As we know, Asia high is often liquidity, and then price moves away. If we go on to the 1 minute, there's an aggressive entry on here, which is very aggressive, but it can be traded. I have taken trades like this in the past. I wouldn't recommend it because you could take a lot of losses, especially in your early stages. But you can see here, Asia high is taken. I wouldn't be up for this time anyway, 6:30 in the morning. I'm not trading at this time. You can see the aggressive move away, the engulfing candle, taken out, so closing below 2 or 3 candles. And you can see a candle mitigation here, mitigating in the inducement high. Okay, so that is an aggressive entry here. That's at 6:40 a.m. So realistically, you're not taking that trade, or I'm not taking that trade. If you go back on the 5 minute though, but what we will do is just mark it up as a potential trade entry, just so we can see where the inducements are and where we expect maybe highs to hold. So you've got this Asia high has been taken out, right? Price moves lower. Before we look for a trade, guys, all right, it's always build up inducement and looking for some kind of mitigation, whether it's mitigation of another POI, like a demand or supply zone somewhere, or an order flow entry of another inducement, something like that, or you're looking for a mitigation of the actual inducement itself. So in this instance here, this is a mitigation of the inducement. So you've got the build up of the channel, bearish channel, you've got the inducement of the channel to the high side, and then you've also got the structural inducement of Asia high. When I'm looking for trades to take, I'm always waiting. If I'm looking for an inducement and I'm waiting for the inducement to finish, obviously the best thing to wait for is the relevant break of structure. Okay. However, the structural inducement is the most important thing for me. So, for example, if I saw a price coming up like this, it stopped here. Let's say it stopped here, didn't take out this high, which is Asia high, came down and broke structure, I would not be taking this mitigation as a trade. And then think of that. I would see that as a smart money trap. Okay. Because I'm always waiting for the structural inducement, the key structural inducement, before I take the trade. So we had that inducement, and we had price breakdown and go the other direction. And then we had London. So 8 a.m. London open, you can see price comes down, and then you can see you had this smaller cycle on the 1 minute. 1 minute for a second. Right, I'm actually going to do this so that Makes it easier to scroll. So for me, this isn't a valid trade. You see, you got this small build up there. You got the aggressive move down, which is the inducement. We've got the break, then you've got the mitigation of the inducement. If you can see it, let me mark it up for you guys. So build up, inducement. Yeah, see it? Apologies, I'm moving mad. Inducement, build up, inducement, and you've got a progressive move away, break, relevant break of structure, and then you've got the mitigation of the inducement, and then moving away. So you could, it's a valid cycle trade, but I don't think for me it's not confirmed enough for me to take, me personally. But if we go back on the 5 minute, okay, you can see price has moved away. So what we're looking at here now is we're seeing that the likelihood of price giving us a reversal from here is low. Why? Because price has come down initially the previous day, it's mitigated that low, and then it's got another mitigation here, another order flow mitigation, right? But then up here, you can see here, it's got the build up, the channel build up, bearish channel build up, the inducement of that channel build up, and then an aggressive move down. But then also what we have, is now price is building up a bullish channel. The more you mark out these channels is the more it will make sense to you, okay? So bullish channel. And then, so you've got the bullish channel building up. So you've got the consecutive mitigations, which is then liquidity being built. This is liquidity being built. Consecutive mitigations is always liquidity being built, all right? You've got the inducement to the left that will happen about 6:30 a.m. You've got the bullish channel. You've got the inducement of that channel to the high side. You've got the structural inducement, which is here, which is it's an M5 candle here, and it's an imbalance on the M5, but it's all on the M1. It's a structural inducement, okay? You got that structural inducement, and your price moves away. It comes back up one more time, takes the higher one more time. Let's look at this. So someone may say, you know, why would you not? Because this is a structural inducement, which is structural inducement. It's into the M5 fair value gap. You've got the strong high here. All right, strong high here. You don't expect this high to be taken necessarily. But then you've got the structural inducement, price moves away. Why not take a trade from here? And the answer is there isn't a clean relative break of structure. So you could take a trade from here because you've got the inducement of the structural high and it's aggressive, but it would have been a loss. And this is why this trade over here to the left isn't a highly confirmed trade. It's super aggressive. The timing isn't great. Hence why it's not the best of trades. But it's still a valid trade, if that makes sense. It makes sense, but it doesn't mean it's super confirmed, right? So this is why relative break of structures and things like that are useful to have in your trading plan. So price comes up one more time, takes out this internal high, aggressively moves away, breaks multiple levels, multiple lows. Okay. And then even bounces off of this low here. But what this is, what do you guys know what this is? This is just a smart money trap. Right? This is just an SMT. It's a smart money trap. So price gives us the reaction off the low, comes back up, and what does it do here? And this is when this is where you can get the seriously high risk to reward trades. You've got this inducement high, which actually created equal highs on the 1 minute. See these highs? See this high here and this high here? Equal highs on the M1. It took out the equal highs before aggressively coming down, and then you've got price coming back up. Also, you've got the structural inducement here, and you've got the mitigation of the very last candle, which is the inducement high candle. Valid. High holds, aggressive move away. Okay. Why is this a valid trade? Let's look at the trade in isolation. So this is why you don't always need the higher time frame. So let's take the higher time frame out of the picture. Let's just look on the M5 for a second. Okay. And let's actually go replay a bit more so we can see before we go into it. Let's look at this just as a cycle on the day. So you've got the bearish build up, inducement to the high side, and then you've got inducement of the Asia high, price comes lower, mitigates these lows, the low here, gives us consistent mitigations, pretty much starting to build a trend line here. 1, 2, 3. Is that not a trend line? So you've got liquidity waiting here. And then you've got this bullish channel, right? So you've got liquidity being created here with these mitigations. You've got this bullish channel. So you've got this build up down here, build up here, inducement, mitigating this area or mitigating, you know, maybe you can call it the imbalance. Then you've got it internal on the M1. You've got the equal highs created. You've got the relevant breakout structures on the M1. You've got liquidity to take on the M1 as well as as price is going back into the inducement high. And then price, and also you've got timing, 1 o'clock, 1 p.m. UK time, which is New York open. The timing is beautiful. So you've got the build up here. You've got build up all the way down here as well. You've got the inducement, aggressive move higher. You've got your inducement high. You've got your relevant break of structure. And you've got your mitigation. The mitigation of the inducement high. And then you've got your build up to attack. Look, so even if you don't want to go for these lows, right? You can just, if you wanted to, you could just, and this is gold, so you'd have to, you know, really put some more of a stop loss for spread. So let's say it's a 5 pip stop loss, but let's say you went for a 10 pip stop loss, just that 5 pip for spread. Depends on what you're using, right? Broker, prop firm, whatever. And then you targeted there, 12R. Hopefully the trade's making sense. And this build up right here is what makes it really make sense. And then price, the high holds and aggressively moves away. And what else? Whoa. So let's go back for a second. I should have paused it before I got to it. But look, what's that looking like to you guys? We've got a build up still that hasn't been taken out yet. We're still in New York. We're approaching 2 p.m. in New York open, right? New York trap time, right? You've got trendline liquidity being built on the low side. You've got trendline liquidity on the high side. So on the high time frame, which let's say the M5 is the high time frame, because this channel needs to be taken out. What do we expect price to do? You've got the aggressive move away here. Yeah, you've got this nice imbalance to attack. What do you expect price to do? Induce higher to go lower, right? Induce higher to go lower. Absolute beauty. How could you have got into this trade? So this is probably a trickier one in the sense that the safest option would be you've got liquidity to take. So the safest option would be to enter on the imbalance, stop loss above the high completely over here to be safe, targeting the bearish channel or even targeting and then maybe, you know, this low here rather than this low. Why not the lowest low? I say not the lowest low because often what happens, you'll see it time and time again, price will build up more liquidity by not taking the low because it will induce more retail traders to get in because they'll believe that this low is, when I say retail, by the way, we're all retail traders, but you know what I mean, people that trade retail strategies, because they'll believe that this low is like a low that, you know, it's a strong low that won't get broken. So it will induce buyers to get into the market before eventually taking them out to then go higher, right? So if you don't want to hold trades overnight, then I recommend going for the safest targets. And this one here, this bottom of the London low and on the bottom of this bearish channel, that's the safest target. So let's mark that out. Let's go for safe targets because it's about consistency and let's keep these things realistic, right? So that's another opportunity. Or you can try and, you know, get in after aggressive inducement and then the candle closes below aggressively like that, engulfs and closes. Maybe you can try getting on the market execution, start loss above the high of the inducement, and then you target the low again for roughly a 6R, somewhere along those lines. That's the chance, but that's more advanced as you know you really start to understand the liquidity cycles and trading that way, right? I'm going to delete this so that it doesn't get too clogged up. I'm going to add in this trade here. But as I said, guys, that trade isn't the most confirmed. I'm being transparent there. It's not a trade that I would take, but I'm just showing you the possibilities. All right. You can target, let's say this low here, which would be the structural low on the M1, right? So got those two trades there. You got a third trade here. And then see how price plays out. Let's go back to the 5 minute. Now we're approaching London close, 3 p.m. UK time. And then again, okay. So what we have here again is, as you can see it for yourself again, guys, look. Price is just adding more. So it's taking out this low here. Reversed. Another liquidity cycle here. Let's have a look at it on the M1. Build up. Look at these consistent mitigations. When you see this, you know that they're about to get swept. Build up. Inducement. You see the vector candles, the aggressive vector candles. Inducement. Right, during London close. Mitigation. And I would say this is a candle mitigation trade. But you see there's a small imbalance in here. Nice inducement taken out. You could end up with someone in this zone, which is this imbalance after the price reverses. You can see price becoming aggressive. You can take the candle mitigation entry. Stop loss below the inducement low. And where would I target? I would target realistically, personally, here. Why here? Because I would look at this as a mini channel build up and as my structural high to target. Hopefully that makes sense for like a 5 or 6R kind of trade. Okay, London close trade. So this will be the last trade of the day. See, this is inducement high, and then again, you can just see here that it's the same kind of thing. It's the inducement high. You got the engulfing candle response, and then you got imbalances here, and you can see here if you want to really play around, enter again. You know that price is gonna induce higher to then go lower, and then another 4.5R, right? If we're on the 5 minute, you can see here the imbalance fill mitigates this wick. Imbalance fill, got the response, and again, price mitigates the wick response to then take out this low down here. Okay. There's the possibilities when you trade liquidity cycles, understanding build-ups, build-up, inducement mitigation. It's super simple, but it's not easy because this takes time to train your eye, and you'll notice this yourself. Because to spot it in real time is a lot more difficult than spotting it in hindsight. But if you practice it enough, I'm telling you, your growth will be insane. Just do these markups daily, your growth will be insane. Okay, so let's talk about the liquidity being swept before I end this video. So what's price doing here? So perfect. Let's see what happens. I'm gonna pause it here now, right? Because I looked at this as a trade here, and then this is what it does. So you got here the previous day, price takes out that low, gets mitigated, price again builds up with this trendline liquidity. This low takes it out. Again, you've got internal low on the M1 probably. You got see this little wick here. Taken out. Mitigation here. Like it's so simple and clean, but it's too clean. It's too simple. You got to build up here. Trend line taken out. Boom. Price goes up, break structure. And I'm telling you, like maybe a year ago, or even maybe less than that, probably like maybe earlier in the year, a trade like this is one I would have taken, because you got like another build up, which is a channel, which is valid build up, and then you're looking at this, you're like, oh, perfect mitigation, right? Like, what's wrong with this? You got a build up, channel or trend line, swept, break of structure, yeah, which is the red line, liquidity to take into the entry, boom. Surely price is gonna just come down, tag me in, and then go for a reversal. Surely that's what price is going to do, right? See, that's what I would have thought back in the day, like earlier in the year. But no. Remember what we said about the hard time frame? This is when we go back to the hard time frame now. So what we've really got on the 15-minute now, first of all, so we've got that massive inducement on the 1 hour of all these lows here. And then what you've got, price has built up more buyers and even more sellers in here. Right? So what you really got here, and you might have spotted it already, maybe you're not though, channel. See it? It's not always super clear, but it's basically a channel. When you see inconsistent mitigations like this, it forms a channel. And then you basically got a channel on the other side as well. Because look, trend line liquidity. You got a channel on that side too, pretty much. I wouldn't say it's as clean, but you got multiple mitigations here. And this is where smart money traders would have got caught out. It's just a smart money trap. And price just used news as an excuse, used CPI as an excuse to take everyone out before it flew. That's all price did. It used CPI as an excuse. That's all price did. It waited to take out all of the early buyers. Everyone that bought early, everyone that bought in here, took them out, and then was like, thank you very much. All the liquidity's been taken. Now we're going to go. And this is where now we want to buy. Right? This is where now we want to buy. If I'm honest, for me, I would want to buy straight after these lows were taken out, but I couldn't find anything in there. Let me show you why. In regards to the 1 minute, look at that. Where am I going to buy in here? Yes, you could argue maybe like try and find something in here, but for me there was nothing clean, so I didn't take it. But hopefully that makes sense to you guys. And this is why understanding the bigger picture is helpful, because now on the 1 hour you got this consistent mitigations. So what do you think this is? Build up. And is price going to necessarily go and just take it all out? Maybe, but it might just come up, come back down, stall a bit, take another high, but go lower, might stall a bit, create more liquidity, people selling off, then boom, take out everybody. Take out this high eventually, yeah, and take out everyone else that's been induced to get into sells before price takes the high. Hopefully you found this useful, guys. God bless, take care, and catch you soon.